Agree. Today's event is titled The Enduring Work of Tax Reform and the Search for New Sources of Revenue. And the title reflects the need for many states to reform their tax systems, partly driven by the changes to the federal tax system and partly driven by their economic circumstances. States were worried about the effects of the Tax Cuts and Jobs Act when it was passed at the end of 2017. They in particular were worried that their state income tax revenues would be more volatile, and it was hard to predict what the results were going to be due to shifting payments over time and changes in federal deductibility. And states have been casting about for new sources of revenue as they kind of bump up against the political limits of existing revenue sources. We have an expert panel today to discuss this topic and more. But before we get to the panel, let me go over a few logistics. So as you're facing the stage, the door's off to your left. That's for the way you exit the facility, but there's refreshments, as you know, and restrooms out in that direction. We encourage all the audience, both those in person and those who might be watching online, to join in the conversation via social media using the hashtag #LiveAtUrban, as it has on the screen. We have a great panel today, ready and willing to discuss all the important fiscal issues facing state governments at this time and into the near future. The panel discussion will be followed by a question and answer session. So y'all should write down your questions or remember your questions, and you have an opportunity to ask them of the panelists at the end of the moderated discussion. And what I'd like to do now is introduce the moderator for today's panel, Howard Glickman. Howard's a senior fellow at the Urban-Brookings Tax Policy Center. He's the editor and the frequent contributor to TaxVox, which is Tax Policy Center's blog on all things fiscal. He's an authority on long-term care issues, which may be helpful today because we'll be discussing some states' chronic long-term fiscal problems. So let me welcome Howard and the panelists to the stage, and then Howard will be introducing our panelists.
Thank you, Mark. Thank you all for coming. This is, as Mark suggested, a very interesting time for states. On one hand, many are swimming in tax revenue, thanks to a strong economy and the benefits of the Tax Cuts and Jobs Act, a law that many states actually said they hated. On the other hand, there are states that feel some real risks to their future revenues. We're going to talk about revenues. We're going to talk about what states are doing with their money, and how some, at least, are thinking about reforming their tax structures. Our panelists today, you have longer bios, but very briefly. John Hicks, next to me, is Executive Director of National Association of State Budget Officers. Kim Rubin is a Saul Price Fellow at the Urban-Brookings Tax Policy Center and the Director of the State and Local Finance Initiative at Urban. Next to her is Joseph Bishop Henchman. Joe's Executive Vice President of the Tax Foundation. And finally, Nick Johnson is a Senior Vice President at the State Fiscal Policy at the Center on Budget and Policy Priorities. We're going to have an informal conversation really among ourselves for a while, and then we'll turn it over to you for some questions. So let me start with John. I wonder if you could just give us an overview of state revenues for this budget year.
Thanks, Howard. The word I would use is very improved. We have states' revenue growth for the year we're in and last year as a back-to-back are the best that we've seen since just prior to the Great Recession. But there's a story behind that it makes it more unusual than past good times. And that has to do with the interactivity of the Tax Cut and Jobs Act and the timing of personal income tax payments. For states' general fund, the personal income tax as a group of 50 is about 45% of our money. So personal income tax is a very important stream of revenue. And so last year we finished fiscal 18 with personal income tax growth on a median basis of about 8%, which is a really high number. But the story was in December, estimated taxpayers walked down to their tax office and wrote a check in December. It was a check they would have written maybe in April, the later year. So we got a whole bunch of money.
December 2017.
December of 2017, thank you, Kim. And so last year, fiscal 18, we were waiting in April to maybe give a bunch of that money back in tax refunds when filers filed. We didn't. And so in turn, states talked about the significant amount of non-wage income being the driver of a lot of that increase. While withholding has been good, the real boost in income was a result of capital gains and dividends and bonuses and other non-wage income. So states had revenue surpluses at the end of fiscal 18. Revenue surpluses they didn't count on or have time to act on. The good news is a whole bunch of that went into our rainy day funds as a function of the law of that state of what do you do with a year-end surplus. Then we walk into this year doing pretty well going into November. And then suddenly in December of 2018, estimated tax payments dropped like a rock, almost like 40% over the prior period. And then in January, also a big decline. And so revenue collectors were wondering what's going on. This definitely has something to do with the fact there's no longer an incentive for a wealthier taxpayer to pay their taxes in December because of the $10,000 federal, state, and local tax deduction limitation. And so clearly timing is now new to state revenue collections. And so states were speculating that come April, we may be all right, but we're not sure. Well, April came and we did get back that money, almost a 40% increase in estimated payments or final payments across the board, still waiting to get some states in. So we were rising high November and we dropped. And what we've done with April is come right back to where we are from November. And that's about a 6.5% increase in revenues on the income tax side and about a 6% increase in revenues total general fund. More than estimated. So we're looking at surpluses again, Howard, this coming end of the year. And so I'll call this late money. We got late money last year and we're getting late money this year, more than estimated. Only 9 states have a new revenue estimate for the fiscal 20 that incorporates the April tax receipts. Most of the states have already completed their revenue estimates and are completing their budgets. And so a lot of money is going to roll into rainy day funds and ending balances again at the end of this year if May and June come out as it normally would. So it's been a topsy-turvy couple of years, a good period for states. And I want to add on to rainy day funds have been the beneficiary of a lot of this extra money or money greater than budgeted. Before the Great Recession, we had dropped down to about 2% of our spending in terms of the amount we have in our savings account. We've been slowly building it back up. Beyond that which we were before the Great Recession, beyond the point we were in the early 2000 recession, we're at record levels of rainy day funds across the country. We're going to end up at about 7.5% or more at the end of this fiscal year, and 7.5% is what was estimated in governors' budgets, and so we're probably going to exceed that. So the good news about late money is sometimes it's non-recurring. There's caution here about how much of that non-wage income would repeat itself next year, and so a good use of one-time money is to store it away to prepare for the next recession, which has been one of the highlights of governors and legislative budget proposals as they're completing their work now is improving. The Oklahoma governor signed his budget the other day and touted the $1 billion that's going to be in their rainy day fund. The Arizona governor and the legislature came to agreement on some big things, and that was another highlight they made is we're going to have another $1 billion in the rainy day fund. So it's something that as we've looked past the last 30 years, the states really pay more attention to that now. Lessons learned from the last 2 recessions, and this, as I call it, this late money has really been a nice way to increase that, and yet allow the legislature for the subsequent year to be deliberate about how much of that is recurring and what we should do with it.
Great, thank you. So Kim, John's talked a lot about the income tax. Give us more of a sense of where else this revenue is coming from.
So the income tax is the big one in that I think that's where a lot of the uncertainty was. But because there were a couple of other things going on, states got money from other places too. There was the Wayfair decision, there's sports betting, there's new marijuana taxes. So states are actually expanding their revenue sources into other things that are new. And then I think, like, to just highlight what John was talking about, I think governors and legislators are actually doing a good job, a much better job than what they were doing right after the Great Recession as we went into the recovery originally, where I think a lot of states saw money improving, made a lot of very drastic tax cuts. So in my mind, I feel like what we've seen over the last couple of years, and starting with what was a really hard budget year, which was the one not in the 2019. So if we're about to get into the 2020 budget year, this year, fiscal year, last year was the 2019 fiscal year. The 2018 fiscal year was a really hard year for states, where a lot of states actually were late getting their budgets done. But what they did in that year is they actually made a lot of improvements in my mind, where they actually took seriously the fact that they had unexpected shortfalls and actually changed a couple of things. We had places like Kansas that actually revisited their income tax cuts. Oklahoma did some of the same thing. And so in some ways, the 2019 fiscal year was a bonus, and this year was a bonus because they were already doing things that looked like it was smarter budgeting. And so the fact that this year a lot of states, starting with last year, got more money from TCJA, and then they also had these Supreme Court decisions that basically authorized sports betting and then authorized their Wayfair decision, which basically means that they can tax internet sales, means that they have other means of revenues coming in. And if you sort of pair that with the fact that the economy is actually doing pretty well, their budgets their money seems pretty good. There is this sense of uncertainty and malaise that if you actually talk to people, they're like, part of the reason they're putting money into the rainy day funds is sort of trying to figure out how long it's going to last and what's going to happen at the federal government to go forward.
Joe, give us a little more of a sense of how this revenue is changing funding priorities. Joe and Kim John and Kim have talked about how a lot of it's going to rainy day funds, but not all of it is. Give us a sense of what else states are doing with that money.
Sure, and let me add my congratulations to you in this wonderful space on Lawn Farm Plaza. It's certainly very fitting of the Urban Institute and its important mission. So, and it's very nice. As John and Kim both suggested, whatever the opposite of a crisis is, that's kind of the situation right now at the state level. I took over state policy at the Tax Foundation in 2009, and my outgoing predecessor, who was on his way to go be Mitch Daniels' budget director, so pretty nice job, but he said, it's very busy during the first third of the year when state legislators are in session, and then the summer it's there's not a lot going on, and you can get caught up on long-term stuff, and then it starts ramping up after the election. None of the years I've been at the Tax Foundation have been like that. We've been in kind of crisis mode since 2009 and probably a little bit before that. So I've never really experienced this is all brand new for me this year, where there really aren't states dealing with major crises. And even the states that have like systemic, unsolvable budget problems like Illinois or Louisiana, we're able to make it through the year okay without actually addressing them. And then you have, I think, states looking at this as the opportunity to look at long-term structural things. So it's not so much how do we balance the budget this year, how do we get through the year, but it's we have the time and in many cases the money to be able to do some pretty dramatic things. And it varies by state what that dramatic thing is. So Texas and Nebraska, their big thing that they have tried to solve for a long time is property taxes. Utah is looking more at sales tax structure and broader structure for the tax system as a whole, which Arkansas was able to tackle this year, overall tax structure. A state like Illinois is looking at the income tax. Some of these were able to result in legislation, most of them didn't, because these are kind of long-term, structural, big things, kind of white whales of some various constituencies in those various states. But they were able to talk about those because there wasn't any other kind of larger crisis overriding those, which has been the case for a long time.
The only thing I'd add to that is the other thing we've seen some states doing, and not necessarily the states you'd expect to do it, is, what we did see last year and over the summer is we did see a lot of like teacher strikes and a lot of interest in understanding what's going on with education and higher ed, and, what we're doing in terms of investing in people. So I think we shouldn't undersell the fact that some states are spending more money, and the places where, you have states like Oklahoma and some states that we don't, right, who don't generally, we think of as sort of increasing their spending on things like education or actually improving those budgets. The other thing is we're seeing more discussion about early childhood stuff. So, I think there's some interesting discussion, and you guys can say whether you see it too, where it feels like there's more discussion about sort of what do we want to reform and where do we need to invest in a way that seems very promising to me.
The pie seems bigger right now. And, we had this national consensus in policy from the 1950s to the 1970s or 80s over, more government involvement in a lot of different spheres of life. But a lot of that was driven by the fact that we could have our cake and eat it too. We could keep taxes low while spending a lot more on a lot of these programs because the economy was growing so dramatically. And then for a period of time, we didn't have that growth, and it really was kind of everybody fighting each other over who would get the crumbs. But now, whether it's how temporary it is, I think is a big debate, but everybody can kind of win. And in those states where nobody can prevail, so a state like Nebraska, where one group wants income tax cuts and another group wants sales tax, another group wants property tax, no one prevails, and so the money just goes to the rainy day fund.
So far, this has been a weird Washington panel because it's been so optimistic. That never happens.
I can fix that.
But
Nick can fix it.
Nick will cure us of this.
Yeah.
The other thing that's going on is there's a lot of uncertainty. There's a lot of political uncertainty. There's some economic uncertainty. Give us a sense of how that uncertainty is affecting state decision-making.
Yeah, I'm very concerned about where we are and are not on state tax reform. And one of the ways I think about this is here we are at the peak, potentially, of this amazing economic expansion. And if you compare the amount of revenues that states are bringing in now compared to how much they brought in at the peak of the expansion in the mid-2000s or the peak of the expansion in the late 1990s, it's well below that as a share of the economy. So what that says to me is that states have so far largely squandered the opportunity that this expansion presented to really rethink their tax codes from the perspective of adequacy. And we saw this manifest itself as, for instance, as Kim mentioned, in the teacher strikes, which were part about teacher pay, but also more generally about investments in the classroom in the face of a pretty large and growing body of evidence that shows that classroom investments actually make important differences in education outcomes and long-term economic outcomes. A lot of states are underinvesting in education, and a lot of those states are ones that have prioritized tax cuts instead of what I would think of as tax reform. So I think we've squandered a lot of opportunities there. I think we have, obviously states have done a pretty good job of putting money into reserves and rainy day funds to prepare for the next recession, which we know is coming. It can't be too far away, but probably not enough, and certainly not as much as you would have thought given the experience of the Great Recession, which, when states took a huge hit, and would have taken an even huger hit had the federal government not stepped in with some a very significant amount of state fiscal relief. And then thirdly, I think states have squandered the opportunity, or to say it another way, states have, over this expansion, have exacerbated what I think is one of the big economic challenges in this country of our times, which is the astonishing concentration of wealth and income in the hands of a smaller and smaller slice of people in this country. So most state tax systems to this day still take more money as a share of income from middle and low income families than they do from upper income families. And that's actually contributing to that, the growing gap. We saw it in some Federal Reserve data that came out just very recently, where a very small slice of the population controls a very large share of the wealth. And this reflects the fact that we have state tax systems that were designed by a small share of the population who controlled state houses for decades and decades, mostly white, powerful legislators who were constructing state tax systems in a certain way. And over this last 10 years, while there's differences from state to state, I don't think we have fully taken advantage of the opportunity that exists for state tax systems to start turning the ship back in a different direction.
So let me ask you, and actually all the panelists, the why question. Why is it that you think that states have missed this opportunity?
Well, we had wave elections, for one thing, in 2010, 2012, 2014, 2016. This fundamental political restructuring of a lot of our states, where even after the elections of 2018, which pushed us back some in the other direction, we still have more states under conservative leadership, more states under Republican leadership than we've had over most of the last decades, and that definitely changed the way states respond. States made their budgeting and tax choices during this expansion compared to in previous ones.
Well, and I would add, having been in state government for almost 35 years, the instances in which a state chooses to raise taxes, general taxes, whether it's sales taxes, whether it's personal income taxes, where it is to create higher brackets in the personal income taxes, it is just not done very often. So without putting a particular partisan spin on that, that's not been what states choose to do when they set up their revenue structures, whether it's good or bad. It's not something that is expected, and it's not something that has happened. And so you started in the introduction, Howard, talking about looking for other revenue sources. Well, that is something that states do, that if they need to find more revenues, the first place they're not looking to do is raise their sales tax or their income taxes, unless there is really a punctuation happens, such as a Supreme Court decision declaring your K-12 system unconstitutional, which has happened across the country in several places. It was the last time my state in Kentucky raised income and sales taxes, was because the Supreme Court said that. So it is just not the rule. Whether there's an opportunity there or not is true, but it's just not the way that states have chosen to set themselves up.
Except we've seen some. Like, I guess I would be more in Nick's camp that we do see this bifurcation, right? We've done some work here. I did some work with Megan Randall, where we actually found that states responded differently to unexpected deficits after the Great Recession than they did before, and it was largely related to whether Republicans were in control or not. And basically, they didn't raise taxes to try and sort of maintain services, they cut things. And they did that more. And we did have this shift to more Republican control. And we have seen in the aftermath of this recession, the Great Recession, in my mind, we've seen this bifurcation. We've seen some states which have basically bet on arguing that they needed to expand the sales tax and cut the income tax, and you'd get all this growth, the whole Texas miracle that hasn't really panned out for other states like Kansas. But then we've seen other states like California and New York and New Jersey and DC and Maryland that actually increased millionaires' taxes, right? So we might see more movement, especially as income inequality becomes the thing, to trying to figure out whether there is a way to rebalance things and whether there is a way to collect more money from certain groups. Now, I don't know if can I go right into SALT, or do you want to do that as a?
We'll talk about SALT in a minute.
Okay, right, so, but I do think that there is this difference. I also want to go back to the fact that I was being relatively optimistic over the last 3 budget cycles, but that's different. Part of that is whether we're at a sort of global peak or a local peak. And I feel like in some ways I'm really impressed with what states are doing right now, in part because I was so unimpressed and like upset with some of the things that they did the first time they got money coming in after the Great Recession. The fact that, as soon as revenues increased, there were certain states that basically slashed taxes, that was what they did rather than restore some spending. I find it just sort of an interesting change in the rhetoric. And I'm also sort of interested in how we're going to see legislatures and the executive work going forward. We have seen more, we've seen a decline in the number of states that have all Republican control, and we've seen an increase in the number that are Democrats. We've also seen this interesting mix where the ones that are split, what we basically see, as opposed to the houses being of different parties, we see governors of one party and houses largely both of the other party, except for Minnesota. And so there is sort of this interesting discussion and description of what's going on. Where is it that you have an executive who's negotiating with people who are very different from them?
So then you have states like Illinois, where they're talking, I mean, Illinois has got all sorts of problems, but I'm interested in their tax reform proposal. They want to go to a graduated income tax system. And I guess the legislature's about to pass it, and it'll go to a referendum. What do you all think about that design? Is there any future in graduated income taxes or more graduated income taxes in states?
Well, it's the president. I mean, most states have graduated rate income taxes. They may be more or less steeply graduated, but Illinois is one of the few states whose constitution is currently interpreted as actually barring them from having a graduated rate. So really all they're doing is proposing to the voters that they had changed the state constitution to allow them to do what almost every other state with an income tax is allowed to do. But I also think that states that do already have the ability to have more graduated income taxes probably will consider more and more adding a new top bracket for the very wealthiest taxpayers, or consider increasing the rates at the top of the income spectrum, simply because there's so much money now at the top of the income spectrum that to leave that aside sort of doesn't make sense. I mean, it's one of the reasons why I think income tax revenues generally at the state level have not kept pace with this economic expansion, because a lot of the economic expansion has occurred at the top of the income spectrum, and state tax codes collect an awful lot of that revenue at the bottom and at the middle of the income spectrum. So there's a little bit of a disconnect there. I also think that you could, and you already are seeing in a lot of states, a bit of a reaction against the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act at the federal level gave enormous tax windfalls to quite well-off households and to corporations. And so I think in a lot of states you are seeing essentially a thought, well, maybe we can claw back a little bit of that revenue, since the federal government's growing, exploding budget deficits are going to mean the federal government may not be as present for states in the future. Maybe states need to take a little bit of that into their own hands and raise a little more of that revenue stateside.
Joe, what do you think about this?
Gosh, where to begin? So starting with Illinois, Illinois has a messed up property tax system. They have a messed up sales tax system. They have messed up business taxes. Income tax, because they are constitutionally required to just have one rate and tax everybody, and tax it the same way, their hands are tied from messing up the income tax. Now, it is not a given that a state with a progressive tax will have a messed up tax system, or even a messed up income tax system. A lot of states do it quite fine. I don't see that in the future for Illinois. I think if they repeal this constitution, they will have 4 messed up tax sources. And the one thing that kind of keeps things going in Illinois, that is this low income tax. People are willing to put up with the rest of it because of countervailing positives, including that. And then that will be gone. One of the things Nick mentioned was wanting to tackle inequality. I've yet to see evidence that state tax policy can meaningfully address that. These states with the highest inequality are also the states with the most progressive tax systems. They're the states with the millionaires' taxes and the income taxes and all of that. Where I do agree with Nick is this is an opportunity that has not really been used for states to tackle structural changes. The one we focus on quite a lot at the Tax Foundation is sales tax reform. Most state tax systems, I would say they're designed badly, but that concedes that they were designed at all. It's just a process of historical evolution and accident that, I can go into a store in Illinois and buy 4 items and pay 4 different sales tax rates on those 4 items, not counting the local sales taxes on top of that, of which there are 10,000 across the United States. Luckily, the Wayfair decision is motivating some states to start looking at the system, including some of the most recalcitrant, like Colorado and Louisiana and Alabama. But there's a lot more that needs to be done. So going back to Illinois, Illinois only taxes about 20% of taxable transactions under its sales tax. So the previous governor, Governor Rauner, when he came in, he said, I will concede that we should expand the sales tax to that if you, the Democrats in the legislature, will concede to structural reforms, to the pension system, to work rules, to a whole bunch of other stuff. And that's where the debate ended, because they weren't willing to concede on any of that. And I think that's going to continue to be the debate in Illinois. So kind of pouring more money into the system without structural changes is like pumping blood into somebody as a transfusion, when that's not solving the underlying problem.
So it seems like states always talk about broadening the sales tax base. And it's a great conversation until it becomes legislation and the lobbyists get to it. And so we can't do my industry because we're special.
Well, let me be optimistic on something then, and this actually praises pretty much everybody on this platform. Yesterday was the 5-year anniversary of the Washington, D.C. tax reform, which included expansion of the sales tax base. And sales tax base, it's one of these things that experts all agree on, but nobody else does. But we were able to get it done in D.C. as part of a comprehensive tax overhaul. Kim, I think you were on the staff associated with drawing up the recommendations for it.
I was on the commission.
You were on the commission
revision
itself.
commission, right.
And then, CBP said nice things about it. Tax Foundation said nice things about it. Grover Norquist said nice things about it. Citizens for Tax Justice said nice things about it. We found a way to advance competitiveness, progressivity, and simplicity. If DC can do it, no state really has an excuse not to even try.
Right. I think that's right. I will point out that I did get more hate mail about the fact that we tax yoga studios than anything else I've ever done from people I know. But like that was something where
all those gyms are doing fine.
All those gyms are doing fine. Yeah. And I think that was sort of a unique situation in some ways where, the commission was sort of the business side and different interest groups, and it was put together as a package, right? So there was some income tax reform that went with the sales tax reform that moved forward, and the fact that DC is going gangbusters. These things are always easier to do, I think, if there is money in the system. But I do agree that I think it would be great if more places thought about what their tax systems look like and thought about how reforming it could actually better serve the needs that they have. This might be taking us in a different direction. Like one of the things that I feel like states need to worry about what's going on with their pensions and sort of where we're going to go when the economy turns down. But one of the things that I'm worried about, and I feel like states are worried about, is one thing that worked really well or pretty well in the last recession was the fact that the federal government actually intervened in a way that was pretty good in terms of helping states in those early years of the Great Recession. I'm worried in the next recession whether we have room in the federal budget or any political will to take that role and to step in. If we can't, if we basically have a whole bunch of Midwestern states that are having tornadoes and underwater, and we can't get a bill through for disaster relief, are we at a point where the federal government will step in and will play that role? And what does that mean for states if they actually have to do more on their own?
So one of the things it might mean, looking at some numbers, just in the last 5 years, 30 states have raised their gas taxes. And I guess that's part of that phenomenon. They've, I don't know about given up, but essentially realize they're not going to get much more from the federal government. John, what do you see in terms of states that are kind of taking on these responsibilities themselves rather than waiting for the feds?
Well, we never waited for the feds for transportation funding at the state and local level because we do the prominent amount of fundraising for roads and bridges in the United States. Mm-hmm. The federal government's an important partner, there, but it's the states who raise the money for transportation. It's 34 states now who have raised their gas taxes in the last 6 years, and we did a metric last year where among those 30, it'd been a quarter century since the last time they'd raised their gas tax prior. So that's a heavy lift for an elected official to make a vote on. There's still a handful of states out there that are debating whether or not to do it again, but that's a really good example of where that has been the most active tax issue in state governments in the last several years has been transportation funding. Half of the states now have electric vehicle fees to be prepared for the replacement loss of fuel tax revenues. So, and then on the expansion of the sales tax base, you know, in state governments, we don't move with mighty speed with most of it at the same time. We move incrementally, slowly, but there are states who are starting to expand their sales taxes base. Iowa and Kentucky did it last year. There have been several states who started to move into digital goods. There's still debate in several states about expanding the base of the sales tax to more services. Connecticut even tried to propose attorneys and accountants. The third rail of sales taxes. So it moves slowly, but there is consideration, and that's not a red-blue issue in terms of the expansion of the sales tax base. That's really getting to a recognition of the loss of the base. Our sales tax revenue growth have not stayed up with the economy. And then the Wayfair decision is going to help that a little bit. On average, we're seeing that the online sales tax implementation is upping sales tax revenues by 2%, roughly. That's a good median of what the estimates have brought in. So there are activities there. And infrastructure is probably the best example of where states have really accepted higher revenue requirements as a function of getting done what they need.
It's not, I don't know where I stand on a federal balanced budget amendment, but I think a lot of it at the state level, the push to have actually solve problems is driven by you just can't go in the red. You can't borrow except for, in limited ways for your operating budget. So you can't just kind of put this off or resolve it. I mean, when the clock comes down on the session, sometimes they'll stop the clock to give them a little more time, but you got to solve these problems at the state level, and they're very proud of that. If you talk to leaders at the state level, that they're able to tackle these in ways that Washington can't.
I want to mention it's a little bit of a disconnect, a tension that exists in a couple of things that have been said, because, John, you pointed out correctly that there is sort of a conventional wisdom that, we don't want to raise taxes, right? It's political. It's politically problematic. It's just not something that states do during a period of economic expansion. And at the same time, when at a more practical level, when you're actually looking at your tax code, when you're actually looking at the revenue needs of a state, of a transportation trust fund, say, the political will does come together around discrete tax increases, and sometimes in very surprising places. Oklahoma last year, for the first time in I think a quarter century, enacted hundreds of millions of dollars of tax increases, overcoming the nation's most strictest supermajority requirement, overcoming a gubernatorial veto, to raise new revenue specifically for K-12 schools. I was really struck this year in New Mexico at how the tenor of the discussion changed in a state where a major source of revenue is oil and gas receipts at a time when oil and gas revenues are actually pretty high, when sort of expected budget gaps had not come to be because oil and gas revenue was coming in. Nonetheless, lawmakers were looking hard at their budget, looking beyond sort of the immediate bump in oil and gas revenues and saying, how are we going to be prepared for the inevitable moment when that revenue goes back down? And then taking a hard look at their tax code and saying, how do we change our income tax revenue to make it less volatile, to put in place some mechanisms so that it will raise revenue if income tax, over time? How do we look at our corporate taxes to reduce the ability of corporations to move their profits from state to state to avoid taxation? So I feel like I actually see a bit of a shift towards that more practical mindset that Joe was mentioning in the area of taxes that pushes against a little bit the sort of reflexive anti-tax dogma that I think was part of for much of the last decade, was sort of part of the DNA of state tax debates.
One of the interesting stories from a few months ago is Washington State, which raised taxes to pay for a public long-term care insurance program. So this is a case where there seemed to have been demand for the program, and they were willing to raise a payroll tax to pay for it. So I guess you're right. There are at least some cases where if the program is popular enough, the legislators will raise taxes to pay for it.
And I think we're seeing that, where basically we're seeing some things where taxes are being introduced, but they're being earmarked and tied to what it's going to be spent on. And there are certain areas that people feel like we need to invest in. I think K-12 got a lot of attention last year. I keep hearing conversations about early childhood stuff. And then we're hearing things about what's going on with sort of training in not necessarily traditional higher education, but sort of other ways that people get the skills they need to work, which, as a public finance economist, you kind of want money to be fungible, and you want it to sort of be able to be applied to the place that is most needed at that moment. But the fact that it seems like voters want to know what they are getting for their dollar is interesting, and it feels like a direction we're going in some places.
I would agree. I mean, transportation is the most prominent example of most of our states have constitutional locks boxes. And part of the willingness to raise transportation dollars, even though it doesn't happen until every quarter century, is transportation has always been considered as a user fee based financing. And so that's why you have fees on electric and hybrid vehicles now, because they're not paying for their use of the road. But you're correct, Kim, in the sense of I do see a continued tendency toward earmarking as being kind of the political necessity to be able to raise or increase a new revenue stream. Marijuana taxes is the most recent example. When our alcohol taxes in the states are not earmarked to be used for something, but our tobacco settlement agreement, 20 years ago became earmarked. Our lottery funds became earmarked. Our marijuana funds are becoming earmarked. It is a way to get things done. It removes the flexibility of the broader state government to be able to move things around and finance those things as things change. It locks them in. But in some cases, it becomes almost the only way to get the vote.
And then ironically, I feel like people sometimes underestimate how much general money is needed for certain things. Right? So something like the fact that people think the lottery pays for education, and it pays for such a small percentage of education. Yet that's how it's being justified to have this, what is in effect a very regressive tax, because the people who are, playing the lottery tend to be lower income, especially in places where we're earmarking that for scholarships for higher education that aren't needs-based, like the Hope scholarships and things. It is especially the case that you have this, what feels like a tax on lower income people that's going to provide money for wealthier people or higher income people.
And it also seems that the states have been very good at gaming the earmarks for things like the tobacco settlement fund. I mean, did they really use the money to pay for tobacco cessation programs, smoking cessation, or did they use it for other things? And I worry sometimes that people say they're going to use the money for a particular purpose, and then states use it, money being fungible, use it.
Well, it happens all the time, and I think at its core, that's what drives voter skepticism. That, let's raise a whole bunch of general taxes and it'll go for wonderful things. People are skeptical, and the higher or farther away the government is from them, in terms of levels, the more skeptical they are that that'll be the case. So to the extent you can calm those fears, and I'm from San Diego, California, where we've got a 0.5-cent sales tax for transportation. And so they lay out, this is what we are going to build. It's a mix of highways and transit and local streets. There will be a separate oversight committee that will review all of the expenses. We're going to give regular reports to it, because they need 2/3 vote on the ballot in order to get this passed. And they regularly get it. And they've had some trouble recently, because it turns out they lied in what they promised. So They're sorting through what they're gonna do on that. But generally, it results in a better product because it's much more refined proposals.
Yeah, I think the problem is it's a false sense of security. Yes, you are giving voters a certain, you're trying to sell something based on an assurance. Oh yeah, this money is going to be lockboxed or whatever for education. But that's giving voters a false sense of security that then down the road actually makes them even more cynical if lottery revenue, for instance, which doesn't grow, which is eroding as other forms of gaming come online, doesn't manage to keep pace with the growing cost of providing K through 12 education. So I think there's a really important difference between actually earmarking revenues versus explaining to voters that the money is needed because the things that state tax dollars pay for, education, transportation, healthcare, public safety, human services, are in fact the building blocks of vital communities, and they have to be funded. And in order to fund them, we're going to have to fix these long-standing problems in our tax codes, which to some extent are a fluke of history. I think to a large extent are a function of the eras in which they were enacted, in which state governments were not nearly as democratic, small d democratic as they are today, were put in place by wealthy and powerful forces. And we have to be able to go to voters and articulate a reform agenda that is tied to sound use of those dollars without artificially earmarking things in ways that will just lead to future voter skepticism. I think that's the only way to get out of this this box of states like Illinois, which for years and years have spent this amount of revenue and brought in this amount of revenue, and it piles up over time to these amazing structural deficits.
If social services and education and transportation are important, and they are, people should be willing to pay for them. The solution should not be, let's dump it on a small percentage of high income earners, which, as you mentioned earlier, creates volatility problems when we do go into the next recession, because half of that revenue is going to vanish. New York had a bad December this last year, revenue-wise, because the stock market had a bad December, revenue-wise. So I think there's a fundamental conflict there of wanting to rely on this group of people while not wanting to rely on them and expecting them to cover all the costs of everything. You know, if there's more fundamental things underlying this trend, then let's talk about how to address it. But I've yet to see the evidence state tax policy meaningfully addresses it. California and New York are the most volatile states in the country, revenue-wise.
And so part of that, if we think about a state like California, is more reliant on its income tax because it can't rely more on its property tax because of Prop 13. And so there is that volatility there. But I think, I love what California's done since the Great Recession, right? I feel like they've been much more responsible than prior. And the fact that they're putting that money into rainy day funds and recognizing the fact that it is volatile. I do think that, if you're going to address rising inequality, it is the case that the states with the most inequality have the most progressive tax system. I feel like the causality is going in the other direction, right? I feel like in some places, the fact that you have a state like California that has a tremendous number of very rich people, but then also a lot of people who are below the poverty line, in part, their income tax is the way it's set up because it's recognizing that, and California is a big enough state that it is hard for people to migrate and avoid it. And so I feel like some of the places where we've seen the most progressive systems, it's because they're recognizing that they do have this variation, where if you're a state that has a very homogeneous population, then it's easier to have things be flat or have it not vary as much because people are all sort of at the same level. The problem, though, is if we start thinking about demographics and what's going on in the future, like part of what I see as the big question, and it's a question with Illinois, but it's also a question in other Midwestern states and states where the demography is changing and the population is changing. In part, Illinois is its own special case in my mind. Like there's a level of corruption or things that were going on in that state that added to it. But if you think about other places like Michigan and like India, other states where they're facing declines in their local governments, and their cities and their populations, but they have these public pension obligations that were largely set up to be on a pay-go basis. But that was set up at a point where populations were growing. Like setting up generous pension benefits in the 1950s, if you're going to have growing populations, helps. It was astounding to me that I saw something, I don't know if it was your numbers or somewhere else, where Flint was like number 2 in terms of cities in 1980. That astounded me. If we think about where Flint is now, and I was at a meeting in the middle of winter one year where basically it was pointed out that Flint owes as much in its public pension payments as it gets in its general revenues. And so part of this is states are going to have to figure out what's going on with their changing populations, which are getting more diverse across the board, across states, and with changing in the aging of the population to sort of figure out how they're going to raise the money that they are going to need to provide what might be more expensive services over a smaller number of people who are working.
And I know this is about tax policy, but the phenomenon that we've observed that kind of states are able to tackle some big structural things because it's not crisis mode right now. It's not limited just to tax policy.
Oh, we can go into it.
Yeah. California's talking seriously about addressing huge problems on housing policy in that state. New York is starting to talk about solving transportation and transportation construction costs, which are a big problem there. There's only so much tax policy can do to address what houses cost in California or whether they can build a new transportation line in New York City. But it all plays a factor, and I'm hopeful that maybe we can tackle some of these at the state level this year, because that only rebounds positively on the tax situation.
So let me switch gears a little bit, and I don't want to run out of time without talking about SALT. So some state governors, Governor Cuomo, said it was a war on his state, the Tax Cuts and Jobs Act cap on SALT deduction. States have tried a number of things to try to respond to this. They tried to turn limited deductible tax payments into fully deductible charitable contributions. They've tried to work with a payroll tax. Nothing seems to have quite worked. I'd like each of you to give me a sense of where you think this story is going, whether we're simply going to settle into a time when the SALT is capped and nobody's going to care, or whether this is going to be an ongoing battle. John, how do you think this is going to play out?
Well, in looking, as you described, some of those attempted workarounds were passed last year in just a handful of states. I mean, really small number of states. And so the jury's still out on a couple of them. It's just the amount of assistance some of that provided. And I'm thinking of Connecticut more than I am New York there. So, states took Joe had talked about opportunities to do structural reform. A lot of states actually took the Tax Cut and Jobs Act as an opportunity to do tax reform. And so there was almost a dozen states who did some very significant move-arounds in their state tax policy to do several things, some of which was to stay revenue neutral with it and not increase the burden on their own state taxpayers. Others, it was to leave a little money on the table. And others was to do some other things, such as broaden the base of even the corporation income tax associated with that. So I saw states using that big change more as an opportunity to rearrange a few things in their state tax policy, not so much to maybe try to give relief to those individuals of higher incomes whose liability increased because of that SALT limit. And so it's going to be a long-term examination as to whether that change will create a greater limit on the ability of state and local governments to raise taxes. I'm not so bearish in that view of that, because I think that is fairly esoteric. But I don't see a lot of change happening, as a result of the states who had the most to lose taking a shot at some options, and some of which were tamped down clearly by federal rules. And so I haven't seen any more experiments pop up out of this current legislative session.
Kim, how do you think this is going to play out?
So first, I think this is sort of a really interesting lesson in the fact that salience or being able to see something matters more than what the actual effect is, right? The fact that a lot of the people who are affected by the SALT or think they were affected by the SALT aren't necessarily, because the federal government got rid of the alternative minimum tax at the same time. So you're very vocal, $150,000 to $300,000 people were already losing their SALT deduction. There are some politics involved in this, and so I think we haven't seen people leave the states, no matter what Governor Cuomo says. Yet, I think it's too soon. I think we are going to see more dancing around where states try things and the federal government responds. There are going to be some unintended consequences, right? There is the interesting part about the federal government's response in terms of the regulations about limiting the ability for people to take charitable contributions instead of state and local tax deductions, in that tax credits for education and all sorts of other tax credits that states were giving places, often red states were given for charitable contributions for tuition for private schools, are also affected by that. So you're going to see this interesting conversation about how do you define these things. I think in some ways it's an interesting conversation in that it highlights the fact that what a lot of nonprofits do and what a lot of state and local governments do in terms of what they provide in services is pretty similar. So sort of figuring out whether there should be this difference between how you treat charity versus state and local government taxes will be an interesting question. I think we're more broadly going to see conversations about what does it mean to keep the itemized deduction if you have only 10% of your population taking it. So we might see some pushback to do something more broad. And it is the fact that it's the people at the top of the income distribution. And I don't know whether it is going to really mean that states are not going to be able to pass progressive taxes. So I think we're going to see a little bit more dancing around or proposals come up. I'm hoping states go slow, especially when we start talking about business taxes and moving income tax stuff to payroll taxes, just because the thing gets complicated for low-income families in terms of you need income to qualify for the earned income tax credit. And so if money is moved from salary to being something that's considered payroll taxes, so salaries go down, you could have circumstances where lower income workers end up being made worse off in an attempt to try and help people at the top of the income distribution keep their SALT deduction. We're thinking about different ways. We might see something where they expand the limit or sort of change what you do on income taxes versus property taxes. I don't think it's done. The part of it that becomes especially interesting is the fact that in theory, in 4 years at this point, it all reverts back to the old tax system. Before that point, we will see either, I think, a new Democratic president who's going to do or want to do a lot of things to the income tax system more broadly. If we take seriously the interest in wealth taxes, so it might be moot as we go forward. Or we might see it, if Republicans retain the presidency and gain control or gain positions in Congress, seeing something where they try and make it permanent. So I think it's going to be an ongoing conversation, but I don't see there being a lot of action fast.
Joe, how do you think it plays out?
Repealing the SALT cap would be a big tax cut for some of the wealthiest people. It was easily the most progressive piece of the Tax Cuts and Jobs Act. So it creates a rhetorical problem for a lot of people. And we've been, at the Tax Foundation, we've been analyzing some of the various SALT restoration bills that have been proposed by Democratic members of Congress. And they're all terrible on the distributional analysis because of just the dynamics of that. It does go, in law, it goes away in a couple of years. We'll see what happens, but, we'll certainly be debating it again, I'm sure. And, John mentioned the jury's still out. It is literal in this case because New York does have a lawsuit against the federal government. I think it's meritless, but, we'll see what the judges say on it. SALT was almost repealed in the 1986 Tax Reform Act. New York kind of threw everything they could at it and managed to put it off for another couple of decades. The consensus then was that this provision was another one of those accidents of history that dates from the original part of the code in 1913, and it has the effect of subsidizing high tax states and allowing them to go rates higher. There's an organization that's not on this stage that would go to states and say, you should raise income taxes, you should adopt millionaires' taxes. The federal government will pick up a third of the tab. That's tremendously bad public finance incentives, and it's now been removed or partially removed, mitigated with this cap, which again is the most progressive element of the TCJA.
Nick, how do you think this is going to play out?
Right, and in addition to what Judge said, it's also really, removing the cap is also really expensive, right? At a time when we already couldn't afford the Tax Cuts and Jobs Act, removing the cap would just increase the cost.
It's about $600 or $700 billion.
Yeah, a vast amount of revenue. So I think most of the discussion is around, is $10,000 the right dollar amount for that? I think the way it's played out in state taxes, I mean, John's, it's turned out to be a bit of a big nothing burger. Turns out both Andrew Cuomo and Arthur Laffer were wrong about this one. You didn't have hundreds of thousands of people decamping the states with significant income taxes because of the cap. So there will be, but Kim's right. This is part of the mix as we head into a big federal tax. I know that federal tax reform is not the topic of this panel, but we are heading into that into that period over the next few years inevitably, and it's hard to imagine this doesn't become part of the mix.
Can I make a prediction?
Sure.
They'll swap it out at some point for a universal deduction cap. So your SALT, your charitable, it'll all go into a larger cap higher than 10,000. But that's what we'll end up
What do
getting.
you think? You taking that bet?
Dollar amount. I mean, the other thing to think about is, should it be a deduction at all? Can we move more to a universal credit for these kinds of policies?
So let me switch gears again and turn to you for questions, but I want to get back to a topic that you all alluded to earlier, which are these other sources of revenue. And there's a whole long, interesting list. There's taxes on sugary drinks, there's marijuana taxes, there's taxes on sports betting, there's the Netflix tax. In Denver just legalized magic mushrooms. I suppose there'll be a tax on that soon enough. Are we going to continue to see states look to these sources of revenue, and are they really going to generate very much money?
The top three questions we get at the Tax Foundation from state legislators over the past year was conformity with the federal tax code and what should we do with our tax system with all the revenue we're getting from it. Wayfair, which 32 states have done something on Wayfair, and that's a decision that was not quite a year ago. So states do move when they want to move. And then marijuana. Yeah. And a lot of it is explaining what you have to do, because it's a lot of updates to a lot of different things, tax and non-tax. Right. You have to make a lot of decisions about how you want to structure it, whether you want to license it or whether, and all that stuff. And the revenue, I mean, it's not nothing, but it's a couple $2 billion nationally, probably maybe $10 billion nationally. So not enough to, repeal your property taxes with or something like that. And I think a lot of the motivation of why we're getting questions from state legislators is that it will be a revenue patch for some other priority that they want to do. And so we've got to kind of talk people out of that. But states are still pursuing it, and I don't think we're that far off from federal legalization on it.
Well, and the other thing I would just say is, I think especially with marijuana, the fact that you have a couple of states that were early movers and they're getting a ton of money, right? They see Colorado and they see Washington, and the argument that it just needs to be highlighted that, as other states come on board, like other things that we saw, as it diffuses, the amount of money any one place gets is going to go down. And they're volatile, right? So the sports betting, so Richard Oxer, who works with us, just released a paper on this, and I've learned all sorts of new terms. So if you want to legally bet on sports teams. But that's also something where legislators thought they were going to get a ton of money because there's so much betting going on, and it doesn't recognize the fact that much of the money that's getting bet gets paid out, right? There are winners and losers, so it's not just the size of how much is happening. And then that's something that's going to end up being really volatile. Rhode Island got its bill in, had sports betting, passed, unfortunately right before the Super Bowl, and ended up getting, totally, they lost money on it because everybody bet on the Patriots and they won. And so, you've got to be careful, and you've just got to, realize that some of these things can be very volatile and uncertain, and it's not going to be the replacement for how you're going to pay for your schools.
There's a state that we've mentioned already earlier that has a big budget problem, and we're debating solutions to it. When the Wayfair decision came down, they almost adjourned the session because they assumed, well, that will solve everything for us. So there's an instinct towards that we fight against.
Nick, are these the golden geese that are?
No, they're not the golden geese, and the key point is that the money that would be spent on legal marijuana or on legal sports betting is money that isn't being spent on something else that may well be taxed. So these taxes have a way of cannibalizing each other. They're volatile, and they tend to erode over time. The next big thing comes along. I mean, there was a time when we were having this exact same conversation about state lotteries, which have flat or eroded. So we have this conversation about what is the next thing. And it never becomes the long-term solution to state, which isn't to say states shouldn't tackle it. They should be thinking about marijuana. I mean, the main reason to legalize marijuana is not for the revenue. It's because it's probably pretty lousy criminal justice policy to be chasing down small-time marijuana users, using resources for that. It's the racial disparities, the economic disparities in marijuana, law enforcement, or terror. Yeah, and so. That's the main reason to be thinking about marijuana legalization. And it's actually prompting some really interesting discussions about how do you use the revenue from marijuana legalization. It's got in addition to all of the really important technical concerns that Joe raises about how you structure a marijuana tax, there's also sort of social economy questions about, well, what are we trying to, when we're legalizing marijuana, can we use that revenue to start to unwind the harm that these disparate enforcement practices over a period of decades and decades did to a lot of our communities? So a number of the legislators in New York, who you would have expected to simply sign along to marijuana legislation, are saying, hold on, we want to make sure that this legislation, in all respects, including the use of the revenue, is actually going to benefit the communities of color, low-income communities that for so many years were left out by these disparate enforcement practices. So it is sparking some really interesting debates.
Yeah, as well as the prospect of licensing to some of those communities as being another economic boost. In a couple of instances, particularly with sports betting and with legalization of marijuana, there's a strong argument that those monies are already being spent in the black market and once legalization, so there isn't quite the substitution problem that maybe you had with lottery, because short of some big cities, you didn't have the numbers games, in the middle of America when the lottery came. So in some cases, this is simply expanding the base. The Wayfair decision was the very thing. It was, you were precluded from collecting what was due already, and so as Joe mentioned, the number of states, I've never seen states move so fast as not only to set thresholds on, the like South Dakota did and the case alluded to, but also to pass with these marketplace facilitator collector laws so that the small business person in a state is not burdened so much by having to figure it out. So I counted over 30, I think, this morning before I came here, so that is moving quickly. And as states say, that's to get the money you're already supposed to pay on your income tax return when you fills out the use tax. But sports betting was never expected to be a big number. I've talked to Richard about this. When I picked up the phone and called the Nevada revenue estimator about a year ago, and they said only $17 million in the only state that had sports betting, that's all I needed to hear. But I will say some kudos to Pennsylvania, who's figured out how to get money out of it. At $10 million per license. I think they've sold, they've granted 8 licenses. $80 million is not a small number. It's one time, but it's not a small number. And then New Jersey and others are following, who basically let you bet on your phone. Which is the other way you're gonna, get some decent money, and they're gonna outdo Nevada this year in terms of their sports betting. So in some cases, those are incremental changes rather than new changes. Fantasy football, fantasy sports betting being another expansion. We started with lotteries, right? We went to Keno. This is nothing but another notch on that same thing. There's nothing really big new about this, but they're not big revenue gainers. But as a longtime budget person in the state, there's no more important $1 million than the last $1 million.
Can I just?
Real quick, and then we'll give people a chance to.
The other thing to think about, because the other thing, it's whether these things are taxing bads. Like when we started taxing things like cigarettes, and even some of the conversation about taxing soda, it's about trying to discourage behavior. So if you think about when states are talking about things like carbon taxes or certain things, are they trying to discourage the behavior? In which case you have this double dividend where you basically get some money in, but you're also trying to affect what people are doing, but you need to recognize the fact that that money ideally will go away if people stop doing it, versus something that you see as sort of, Norton Francis at the NTA meeting brought this up when he was a discussant about whether it's entertainment, right? Is gambling and sports betting entertainment rather than sin? Or is it entertainment and sin? But you could have different thoughts about the money and why you want to tax certain things and how we're moving in these directions.
Okay, great. Let me give you all a chance to ask a few questions. I'd like to ask you to please introduce yourselves and please make it a question and not a statement. Yes, ma'am.
Wait for the mic.
It's coming. There you go.
Thank you very much. I identify as a Midwesterner, and Trump has now appropriated or asserted $16 billion in a bailout for large-scale farmers, and that was the second. There was another one earlier of umpteen billion. So my question is, if those farmers aren't earning income and so they're getting bailouts, does the states in which those farmers are located lose income, or do they get money from the bailout too?
I don't know if the farmers' payments are taxable at the state level. That would be the main question. But I mean, there's no.
Otherwise, aren't the states losing money? I mean, I guess you're talking about new sources, but I'm asking, are they losing money by these tariffs?
They're certainly not gaining it. And, I think any economist will tell you that tariffs are a tax and a very hurtful tax, especially on export-oriented people like farmers in the Midwest.
Other questions? Yes, ma'am.
Hi, I'm Abby Woodward. I'd like to know more about the financial transaction tax. I don't know much about it, but it sounds to me like that could be a good place to get some income.
It's an idea that pops up pretty regularly. People that watch Superman 2 or Office Space too frequently, with the idea that we'll just take a little fraction out of everything and it will add up to trillions of dollars, but somehow it won't affect the economy and no one will notice it. There have been studies done that it does dramatic damage into investment decisions and the ability to have a functioning financial sector.
Are there any states that are thinking about imposing
I don't
a new
think so.
FTT?
So
New York City, yeah.
They have a tiny one.
So it's the kind of thing, so San Francisco at one point, back when I lived there, so 15 years ago at this point, brought up the idea of having a financial transactions tax or something similar on things that were going on the Pacific Exchange. And so part of the issue and part of why it seems like it would be easier for a country to do it than a state to do it is the fact that especially financial transactions can move to other places. And so you could imagine New York City can think about it, because if you think that the New York Stock Exchange has a certain number of people who are sort of committed to it, but when you're talking about some of the secondary markets, it becomes much tougher, just because figuring out how you're taxing it would be a problem. If you then try and do it where you're taxing not by the exchange, but by where somebody lives, as opposed to wage income, part of it becomes much more difficult, I think, for a place to do than, say, a local or a state to do than for, say, a country to do, because we're talking about things that just by their nature are much harder to pin down as at a specific location and could be more fungible. Nick, do you have a different sense of it?
No, I think that's largely right. I would just say that I think the impetus behind a financial transactions tax is pretty understandable in an era where you're seeing these vast amounts of money changing hands in the financial market. So I have sympathy for the instinct. I haven't seen a really good model for how you would do it at the state or local level.
And lots of bad ones.
Carl.
Thanks, Howard. Carl Pulzer. By way of background, I started a little project about 4 years ago, exploring inequality, and then I have the other part is even-handedly as I can, advocating for the people left out. So my focus is more on the bottom, not on the top. And my question is, I'm very happy to hear inequality popping up around here, but that means that when we pass a tax, we want to look at distribution. And the federal, you guys did a great job of sorting through that, the federal bill. But what is and I'll give an example at the state level, but the question is, what's the appetite, need, or ability of state budget offices and legislatures to do this kind of analysis? Now, as we see these gaps growing, for example, Howard and I both work in long-term care policy and might disagree about this, but Washington State's the first state that passed sort of a payroll tax financed long-term care benefit, less than 1%. And I have serious questions about whether that really doesn't help the bottom half very much, people with no assets. They're going to go on Medicaid anyhow. Yeah, they're going to get this $35,000 benefit, but they would have gotten the same thing on Medicaid. And so mainly, and they die a lot earlier than the wealthier. So that needs to be, I'm not saying I know it, but there needs to be analysis about that, who pays, and who gets on stuff like that.
So that's a good question. So, John, what is the capacity of states to do distributional analysis of tax proposals?
It's variable. There are tax policy divisions, typically in the tax policy and revenue estimating functions of state government, that are very capable of doing distributional analysis, particularly around income taxes, because that becomes the bulk of the work they're asked to do whether it's business taxes or individual income taxes. On sales taxes, I'm less knowledgeable, I'll say, about the ability of states to do that, but some of the capabilities, across, and it's not just large states either, in their ability to know who's paying taxes now, to know the information about their income. They have the data to do that. In some cases, in sales taxes, you've got to make some assumptions around that. But on the income taxes, they've got the data to be able to do that. The question becomes, does the leadership, the decision makers, seek the data, seek the information? Because they're working for the decision makers in that case. And so organizations like some of those here on the panel, are outsiders. And then there are other outside, some of Nick's affiliates have a great capability of doing that, in states that I've seen. So I don't know that it's universal, but I know that there's a lot of capability.
I think we did a study a few years ago where we were looking at which states have the capacity, and there was at least 3 states. At that time, Texas, Minnesota, and Maine, I think all had the ability to do comprehensive multi-tax distributional analyses of the tax system. They actually published that. A lot of other states could do bits and pieces of the tax system, but of course, if you can do bits and pieces, you really are missing sort of the forest for the trees. Since you used the phrase "who pays," I'll do an ad for the organization Institute on Taxation and Economic Policy. Actually, has a publication called "Who Pays" that describes the incidence of taxes across all 50 states. I do think a really interesting dimension of this is things that are closer to fees. I mean, you mentioned the payroll tax to support long-term care in Washington State. You know, we've started, and other organizations started looking at issues of the fees and fines that are levied as part of the criminal justice system that are very challenging, very damaging in low-income communities, in communities of color, and really undermine, I think, the long-term interests of the justice system, and are often driven by fiscal pressures that are coming from above. So I think, you know, attention, but I guess John's point is absolutely right. It's as much getting the policymakers to listen to what the data say about the distribution of taxes as it is about generating the data.
There's a theoretical challenge and a practical one. The theoretical one John touched on already. Whether the property tax is progressive or regressive depends on the share that you think renters are paying as part of the rent that they're paying to landlords. Whether the corporate income tax is progressive or regressive depends on whether you think it appears in lower wages or it appears in lower profits to shareholders. And so you can get very different answers, because those are like huge differences when you analyze state tax systems. So, you know, who pays makes one set of assumptions. I think I would make a different set of assumptions on some of them, but you get dramatically different answers on them. The practical challenge is redistributive policy is less effective at the state level, with some exceptions, than it is at the national level. You know, if you're redistributing within West Virginia or within Mississippi, you're not really going to be able to do a whole lot.
And I was just going to add that, and you brought up something that's really an important part of this that I think is easier to do at the state level, or at least it needs to balance more. In part, it's not only what is the distribution of the taxes, but what is the distribution of the benefits received.
Yeah.
And so figuring out how you tie those together and who's benefiting from something is an important part of this discussion, but also is assumption driven. Like, you have to make assumptions about who's benefiting from certain things.
And we've tried to do this at the federal level, and it's hard. I mean, take the Department of Defense. Who benefits from the Department of Defense? Is it everybody? Is it some people, only some people? And then do we all benefit proportionally to our income? Do we all benefit equally? That drives your result,
but I think
the
that's,
assumption you put into that.
But that's changing the topic, right? That's talking about the spending side of the ledger. If we talk about the tax side of the ledger, you can make some pretty reasonable assumptions about how taxes get distributed, come up with some pretty reasonable answers. You know, Minnesota right now is having a debate about conformity and who is benefiting from their conformity legislation. And it looks like about half of the taxpayers in the state of Minnesota, particularly middle and lower income taxpayers, aren't going to benefit. So what could they do? They could very straightforwardly expand. They have a working families tax credit that would benefit the other families. You know, this is not rocket scientists, and it doesn't have anything to do with, you know, who benefits from defense spending. It's simply this piece of legislation could be of benefit to everyone in Minnesota, or only to a subsection of the people in Minnesota. And that's where I think distributional analysis can be really helpful.
I don't really disagree with you, so I don't know why I'm disagreeing with you, but I mean, we're talking about equity, and I don't see why looking at both sides of the equation isn't a fundamental part of that. So if the goal is we want people to pay, you know, according to their incomes, and then distribute benefits according to, you know, how we want to distribute them, how do you not look at the distribution of benefits?
Okay, we're about out of time. I want to ask one more quick question before we go. This is another whole panel discussion, I think. You probably have all seen in the newspaper over the last couple of days that Oklahoma is suing some drug companies that make opioids. Two of the companies have settled for $350 million. And I wonder if you all think that this is going to be the next tobacco settlement effort to raise revenue. Are we going to see lots of states going after opioid makers and generating lots of revenue?
Yes.
I think we will, but I think it's more complicated, and at least, you know, there is what's going on, especially at the federal level in some of the lawsuits, is who are you holding responsible for this? And Oklahoma is an interesting case in that they're saying that they're disproportionately hurt because they have so many uninsured people who were affected by this, but partly they didn't expand like they could have insured those people. There is a way to do this. I think that there is going to be an interest in having some agreement and getting money in. It's going to be interesting to see whether it is just the manufacturers or they do have a broader set of people involved in the agreement. And unlike cigarettes, it needs to be stated that, there are positive uses of these drugs, that for certain people who are in surgery or going through certain things, it can be incredibly helpful to have access to these things. So it might not be, advertising and pushing it as a problem, but it feels a little more complicated than, say, cigarettes.
Joe, is this going to be a big?
It's a heart-wrenching situation. I hope we can come up with a solution that's not enrich a whole bunch of lawyers.
Nick, last word.
And part of the solution is, in fact, expanding Medicaid so folks can get the treatment they need.
Okay. We're out of time. Thank you all for coming. Thank you to the panel.
Right, can I?
Thank you, sir.
If you're interested in state revenues, and I didn't say this, and if you think, right, the fact that it is fascinating and is more volatile. We've just started a data subscription series, and like Lucy Dodian came from the Rockefeller Institute to Urban. So we're collecting more information on a monthly basis, and we have sheets of paper if you're interested in finding out more about it to gain access. I was supposed to say that at the beginning. I forgot.